I wanted to ask about gold, given it can act as an inflation hedge and the current liquidity stress in what you said yourself last week is one of the world's major markets. So how much gold has now left the BOV vaults in anticipation of tariffs? And with bullion banks looking to borrow from central banks that hold their gold at the BOV, what is the central bank doing to help alleviate current queues?
Dave, do you want to?
Yeah, I think I picked up the question. And look, it's worth, given that this is the NPR press conference, it's worth putting what's been happening to gold, which is the detail of your question, in the context of what's going on in the world economy and the uncertainties out there. It's also worth bearing in mind that, because this helps explain some of the facts around the time it's going to take to get gold out of the bank's vaults, because of the nature of our approach to the gold. So, I mean, the first thing to say, we have the second largest stock of gold in the world, over 400,000 bars of gold at the moment. That's gone down a bit since the end of 2024, reflecting the market conditions that you're talking about and have been a feature in the news. But the stock has gone down by about 2% since the end of, so that's important to keep that in perspective. And, the US gold market has been trading at a premium to the London market, and commercial gold holders have been looking to take advantage of that price differential. So there's been strong demand for delivery slots. We can meet that demand. All of our main counterparties, as it were, or better to say, all of those bodies who ship the gold they've all got the delivery slots they need over the next few weeks. If you were coming in new to us, you might have to wait a bit longer because all the existing slots are booked up. But this is a very orderly process. It is worth stressing compared to some of the markets we usually talk about. I mean, it's an obvious point, but gold is a physical asset, so there are real logistical constraints and security constraints. Getting into the bank for me this morning was a bit trickier because there was a lorry in the bullion yard. But that's just the reality of it. It takes time, and the stuff is also quite heavy, as you know. So, I think these things sometimes get forgotten about in a headline that says, there's a 6-week delay or something like that. There's a lot of demand, but we've got slots for all the people who currently want to get their gold or want to ship gold on behalf of a customer, and we're managing it.
Gold has long been a financial safe haven, but recent developments suggest that its role as a secure asset is more crucial than ever. The ongoing liquidity stress in global financial markets, coupled with speculations about tariffs on gold imports, has led to an unprecedented demand for physical gold. Central banks, institutional investors, and individual savers alike are scrambling to secure their holdings, leading to extended delivery times, rising premiums, and growing concerns about whether all the gold stored in major financial institutions is truly available for withdrawal. The Bank of England, BOE, which houses one of the world's largest gold reserves, has experienced a notable outflow of bullion. Reports indicate that its vaults, once known for their efficiency in processing withdrawals, are now facing delays due to overwhelming demand. In a recent statement, BOE officials reassured investors that the delays were merely logistical, citing security protocols and the sheer weight of the gold being moved. However, investors remain skeptical, with many interpreting these delays as signs of deeper issues within the global bullion market. It is well known that much of the gold stored in central bank vaults has been leased out to bullion banks, who in turn sell it into the market. The concern now is whether these banks can return the borrowed gold when requested, or if they are facing a severe shortfall that could trigger a major liquidity crisis. The U.S. gold market has also been trading at a premium to the London market, further fueling the rush for physical delivery. As gold investors seek to capitalize on this price differential, delivery slots at major vaults have been fully booked for weeks. While the BOE has stated that existing customers will receive their gold as scheduled, new requests may face even longer wait times. This situation underscores a fundamental truth about gold investment. While paper gold, such as ETFs and futures contracts, can be bought and sold instantly, physical gold ownership is subject to the realities of storage, security, and transportation. Investors who want to ensure access to their gold in times of crisis must hold it in a location where they can retrieve it without relying on intermediaries. Adding to the tension, there are growing speculations that the U.S. government might introduce tariffs on imported gold as part of broader trade policy measures. If such tariffs are imposed, the price of gold in the U.S. could rise sharply, making it more expensive for investors to acquire new holdings. This has led to a surge in demand for delivery slots as investors rush to secure their gold before any new tariffs take effect. The expectation of a tariff-induced price spike is already reflected in the market, with gold prices climbing to record highs. As of March 14, 2025, gold reached an all-time peak of $2,993.80 per ounce, driven by geopolitical tensions, inflation concerns, and fears of further financial instability. But what if the problem isn't just logistical delays? What if some of the gold expected to be in these vaults is no longer physically there? This is where the role of gold leasing becomes a critical factor. When central banks lease out gold to bullion banks, it allows those banks to sell gold into the market, lowering prices and creating liquidity. However, this system relies on the assumption that the bullion banks can buy back the gold when needed and return it to the vaults. If a significant number of investors suddenly demand delivery, bullion banks may struggle to repurchase enough gold to meet those requests, especially if supply is tight. The question then becomes, is the delay in gold deliveries purely logistical, or are bullion banks quietly facing a short squeeze? If it is the latter, then we could be witnessing the beginning of what some analysts are calling the mother of all short squeezes. In a traditional short squeeze, traders who have borrowed and sold an asset must buy it back at higher prices when they are forced to return it. If bullion banks have overleased gold and now cannot buy it back affordably, they may find themselves in a liquidity crisis that could send gold prices skyrocketing even further. Hedge funds and large investors are already sensing this possibility, and many have started aggressively buying physical gold, anticipating a price explosion if the short squeeze materializes. For individual investors, the current situation offers both opportunities and risks. On one hand, those who already own physical gold are in a strong position, as their holdings are becoming more valuable by the day. On the other hand, those who rely on paper gold may find themselves in trouble if the market experiences a physical shortage. If you hold gold through an ETF or futures contract, it's crucial to read the fine print. Does your investment actually entitle you to physical gold? Or is it just a claim on gold that may or may not exist in the vaults? The safest strategy remains direct ownership of physical bullion stored in secure, accessible locations.
I suspect, and I don't know this, but I suspect a lot of that gold will have been leased. They'll let the bullion banks who have leased it out.
Yeah.
And if you want to deliver it back to the original owner, you've got to get it back from the people who borrowed it. Now, the question is it that they won't return the gold, or is it that they can't return the gold? Or is it there all along and they've just got logistical problems? You know, they can't find enough Brinks Mat vans to deliver it. I don't know. What he's saying probably is quite true. They're not geared up for lots of deliveries. People don't normally ask for their gold back, but suddenly everybody is asking for their gold back and they're not geared up for it. That's probably true. But just in case it's not, I would want to be at the front of the queue.
That's right. And that means, of course, that you want to get physical gold if you're thinking about it now while you still can, because the retail market is, how can I say, still functioning quite well. It probably will feel the tightness that the wholesale market feels, Clive, and that's why.
Then we've got the hedge funds out there, Mario, and I think the hounds can smell blood.
Clive, so do you think I guess this is the question now, whether there is a bit of squeeze, we have to admit, but will it be the mother of all short squeezes, or is it going to be able to be orderly? What's your feeling?
Well, if I had been sitting there, I would have immediately calmed the market by saying, your gold is safe with us. How would you react to that, Mario?
I would probably think it's not.
You'd probably think, why is he saying it? Yes.
Yeah.
So no, whether there's a real problem or not in terms of the bullion, they're getting be able to get their hands on the bullion to deliver it, or whether it's a logistical problem. I'll go with the logistical problem, but I don't have any gold at the Bank of England, and if I did, I'd be trying to get it now just to be fair. Like in the cinema, you smell a bit of smoke. It might just be someone with a sly cigarette under the seat, but you're not sure. You want to be edging towards the exit.
The gold market is facing one of the most critical moments in its history, as liquidity stress, geopolitical shifts, and growing demand for physical gold create a perfect storm that could redefine the global financial system. The urgency to acquire gold has surged, not just among individual investors, but also among central banks, sovereign wealth funds, and major financial institutions. With the increasing difficulty of withdrawing physical gold from vaults like the Bank of England, BOE, and a growing premium on gold prices in the US compared to London, it is becoming evident that we are witnessing more than just a temporary rush for safe haven assets. This may well be the beginning of a structural shift away from paper-based gold markets toward direct ownership of physical bullion. The deeper we analyze the situation, the clearer it becomes that gold is not just an investment, it is an essential component of financial sovereignty. The global financial system is at an inflection point where faith in fiat currencies is eroding, trust in central banks is weakening, and the demand for real, tangible assets is skyrocketing. In Part 1, we explored the immediate causes of gold's increasing demand, including concerns about tariffs, liquidity bottlenecks, and central bank accumulation. In this expanded discussion, we will dive into the broader implications of a physical gold shortage, how this crisis could reshape monetary policy, and what individual investors should do to safeguard their wealth. For decades, the gold market has been largely driven by paper derivatives, such as ETFs, futures contracts, and unallocated gold accounts. These instruments have allowed financial institutions to trade vast quantities of gold without actually holding physical bullion. While this system has provided liquidity and convenience, it is now being put to the ultimate test. Investors are starting to question whether their gold-backed assets are truly backed by physical gold or whether they are merely paper promises. The main issue with the paper gold system is that it operates on fractional reserves. The COMEX futures market, for instance, has been known to have leverage ratios exceeding 100 to 1, meaning that for every 100 ounces of gold represented in contracts, only 1 ounce of physical gold exists for delivery. This model works under normal circumstances when only a fraction of investors demand physical settlement. However, when confidence in the system is shaken, such as during periods of financial instability, the demand for real gold surges, exposing the flaws of fractional reserve trading. The consequences of this imbalance are now becoming apparent. Reports from the Bank of England and the London Bullion Market Association, LBMA, indicate that delivery times for gold withdrawals are extending, with some clients having to wait weeks or months to access their gold. This delay is being attributed to logistical issues, but many investors fear that the real issue is a lack of sufficient physical gold to meet growing demand. If large financial institutions or hedge funds begin to doubt the ability of these vaults to deliver on their commitments, we could see a widespread loss of confidence in the paper gold market, potentially triggering one of the most significant liquidity crises in modern financial history. Beyond the financial markets, the current gold rush is also being driven by major geopolitical changes. Countries like China, Russia, and India have been aggressively accumulating gold, reducing their dependence on the US dollar in global trade. The BRICS alliance has even discussed the possibility of launching a gold-backed currency as an alternative to the dollar. While such a move is still in the early stages, the fact that multiple nations are actively exploring ways to de-dollarize their economies is a testament to the shifting financial landscape. One of the key reasons for this shift is the increasing use of economic sanctions as a tool of US foreign policy. Countries that have found themselves targeted by these sanctions, such as Russia and Iran, have sought to reduce their exposure to the US financial system by increasing their gold reserves. Unlike fiat currencies, gold is immune to sanctions. It cannot be frozen in a bank account, devalued by monetary policy, or restricted by international institutions. As a result, more nations are viewing gold as the ultimate store of value in an uncertain geopolitical environment. This trend has significant implications for the future of the global monetary system. If major economies continue to move toward gold-backed trade agreements, the role of the US dollar as the world's primary reserve currency could be weakened. While this transition will not happen overnight, the increasing demand for gold as a strategic asset suggests that the financial system is gradually shifting toward a more commodity-backed model. Whenever gold experiences a dramatic rise in value, there is always the lingering question of whether governments will attempt to confiscate it as they did in the past. The most infamous example of this occurred in 1933, when President Franklin D. Roosevelt issued Executive Order 6102, forcing American citizens to surrender their gold holdings in exchange for paper currency at a fixed rate. Shortly after, the government devalued the dollar, effectively transferring wealth from private citizens to the state. While outright confiscation seems less likely in the modern era, governments have other tools at their disposal to control gold ownership. One possibility is the imposition of heavy taxes on gold transactions or capital gains, making it less attractive as an investment. Another strategy could involve restricting gold exports or placing limits on private ownership of bullion. Given the current trajectory of monetary policy, where central banks are struggling to control inflation and maintain confidence in fiat currencies, it is not unreasonable to consider that governments may once again target gold as a way to maintain financial control. For investors, the best way to mitigate these risks is through careful diversification. Holding gold in multiple jurisdictions, particularly in countries with strong legal protections for private ownership, can provide a safeguard against potential government overreach. Offshore gold storage in Switzerland, Singapore, or Liechtenstein remains a viable option for those seeking additional security. While gold is at the center of the discussion, silver remains an overlooked but highly valuable asset. Unlike gold, which is primarily used for investment in central bank reserves, silver has extensive industrial applications. It is a critical component in solar panels, electric vehicles, and medical technology, making it an essential resource in the transition to a more technologically advanced economy. The gold-to-silver ratio, which currently sits at over 80-1, suggests that silver is significantly undervalued relative to gold. Historically, when this ratio has been at such elevated levels, silver has experienced dramatic price increases as it corrects to a more balanced valuation. If gold prices continue to rise, silver could offer even greater percentage gains, making it an attractive option for investors looking to diversify their precious metals holdings. The ongoing liquidity crisis in the gold market is not just a short-term phenomenon, it is a reflection of deeper structural issues within the global financial system. The reliance on paper gold, the excessive use of gold leasing, and the increasing demand for physical bullion are all converging to create a moment of reckoning. Investors who understand these dynamics and take proactive steps to secure physical gold will be in a far stronger position than those who rely on the traditional financial system to safeguard their wealth. As geopolitical tensions continue to rise, central banks accumulate gold at record levels, and the risk of financial instability grows. The importance of gold and silver as wealth preservation tools cannot be overstated. The window of opportunity to acquire these assets at reasonable prices is closing rapidly. Those who act now will be better prepared for whatever economic challenges lie ahead. In the end, gold is not just an asset, it is a statement of financial independence. Those who own physical gold and silver are not just hedging against inflation, they are preparing for a future where tangible, real assets will define financial security. The time to act is now. Stay informed, stay prepared, and as always, keep stacking.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.